We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisade's Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Chris Macintosh, hedge fund manager who has lived and invested in 7 different countries and also the founder of CapitalistExploits.com. Chris, thanks for joining me today.
It's a pleasure to be here, Tom. We were just chatting offline, and we've actually kind of known each other for some time, but we've never formally been introduced and spoken online. So it's a pleasure to be here.
Absolutely. It's a pleasure to get some time with you today. You know, being in some of these same circles, having some of these same influences is an absolute pleasure. And, you know, I don't think this conversation will be any exception to that today.
I'm sure we're going to have fun.
So as investors and really anybody paying attention to the world right now, we recognize that there are, recalibrations and rotations of capital starting to materialize in the world. So where do you see the biggest changes occurring right now? And how do you try to get perspective on these changes?
Wow, where to start? I mean, there are changes that are in play that have been in motion now for years or decades, and then there's ones that are more shorter in time frame and nature. And so broadly, what we've seen for the last few, if we go back 20 odd years, we've had a large deindustrialization of the West. Okay, production facilities and so on and so forth have been outsourced largely to the East. It's your typical Apple. Think about Apple, like where it's ostensibly a Californian company, right? But it's not Californian in really in any shape or form. There's a bit of R&D sitting in California, but all of the actual production takes place offshore. And the same is true of many corporate entities. And this is true throughout Europe, the UK, America, Canada, most of the West. That's largely come about as a consequence of wage disparities across regions and an increase in technical and to some extent infrastructure that has gotten better in Eastern countries like Vietnam, Philippines, you name it. Anyways, so that's been taking place for decades. The interesting component is that what we've had from the Western side of things, to supplant that, we've increasingly financialized things. Okay. The disconnect that I see now is that within financial markets, your market cap of the Western nations in general is massive comparative to the company or the country's market caps, which have the actual production facilities. Mm-hmm. Okay. That's one thing. And a lot of that financialization is also built on the back of credit. So we look at the credit situation and your debtors and your creditors. So from that perspective, when you're taking like a 40,000-foot view, you've got a massive disconnect. The other disconnect is more short-term in nature, which I think it feels like it's, I hate to use the word imminent, Tom, but it kind of feels imminent. And it's one topic that we've been talking about a lot in our newsletter, which is the Mag 7, or say the top 10 companies within the S&P 500, which now account for one of the largest percentages that we've had in history of the S&P. So we've got this distribution that exists within the financial markets that is anomalous. Okay. Part of the reasoning behind why that is true actually comes back to something that a friend of mine, Michael Green, talks about, which is passive capital flows. So you've got passive capital. When I say passive capital, I'm talking about people putting automatic distributions into their 401ks in the US and whatever. The same is true in most any socialized country. So like when I say socialized, you got basically the West. It's a democratic quite democratic. I use the word with a bit of a laugh, because I think that's a bit of a joke. Nevertheless, they are economically social countries. It's the economic structure is social, and that's a very important concept, because that also that's a liability, right? There's a social contract that exists. There's pension funds, it's healthcare, it's education, it's all these sorts of things. The capital that is being deployed within those markets has been increasingly, and this has been true for the last 20 years, but it's been accelerating, has been commandeered by quote unquote passive capital. So these are your index funds, your mutual funds, your Vanguards, your BlackRocks. And the business model that exists with that, Tom, is quite simple. It's aggregate as much capital as you can that don't really concern themselves with returns per se. So it's not like an active manager like myself, where I'm sitting there, I'm trying to figure things out and make sure that I make money, because my business model actually requires me to make money for my clients. If I don't make money for my clients, purely as a consequence of aggregate capital under management, it's not very profitable for me, okay? On the other hand, if I had billions of dollars under management, I could quite easily not give a shit about actual returns, because I'm not worried about the 20. Like if you think about a 2 and 20 model, I don't care about the 20 if I've got billions under management. Also, and if I'm not worried too much about returns, in terms of my own business model, I don't have to go and hire analysts and figure things out. All I want to do is hire enough people on the front end to market and pull in capital, and then charge them 85 basis points or whatever it is to come into some ETF or some fund or some mutual fund. And then within that mutual fund world, I'll go and pick a whole lot of other mutual funds, which I also own, which will also have probably 85 basis point cost structure on them. Mm-hmm. So all up, I can be charging someone 4 or 5% on billions of dollars. I get very wealthy very quickly. In any way, the marketing concept behind this is quite simple. People believe, oh, why would I pay 2 and 20 to an active fund manager over here? And this guy over here is going to charge me 85 basis points for the capital, not realizing that you're paying way more than 85 basis points when you go through the entire structure. Or what they pull you in, and then they're selling you a whole lot of other product suites that each and every one of those have got their own fee structure on. Nevertheless, that has been growing exponentially. Now, those passive capital flows don't care at all about returns. They go in on a weighted basis based on market cap. Okay, so for example, if you got Microsoft, they had roughly $3 trillion, and you're going to put in a 1% capital allocation, it's going to go in based on that market cap. Then you might have, I don't know, take one of the companies we've been owning for a while, Tidewater, tiny market cap in comparison. And you go in a 1% allocation on that, you got a much, much smaller amount of capital. So what you're getting is this, and one other point, sorry, I'm jumping around a little bit here, but it's important for people to understand. These passive capital buckets, if you will, are so large that they cannot invest into medium or small cap companies any longer. Okay. So the capital gets further skewed into large cap companies and those that have got sufficient volume. Okay. That's another thing. You could have a large cap company, but if the volume is not high, like so let's say you and I had a company and it was worth $50 billion, but it's only you and I. Like the amount that you and I trade is going to be a tiny, tiny amount of volume trading in the stock, right? Maybe we're just selling stock every now and then to go and buy lunch. Okay, so it's like a tiny amount of money that's in terms of volume, but it's a very large market cap company. So, and these passive capital flows will go also in on a volume weighted basis. So you get a further distribution skew where you can have a company that's large, but it's not trading a lot of volume. Anyway, so you're getting a lot of skews within the market. My concern with all of this is that the amount of capital that has been going into the Mag 7 in general. The reason the Mag 7 keeps getting bigger, the reason it exists is largely as a consequence of these passive capital flows, where they don't care about anything other than volume of shares traded and market cap. That's a terrible way for anyone to invest. You can imagine, because you're just bidding on a company. You don't care whether they're profitable. You don't care what the PE ratio is. You don't care about the cost structure. You don't care if they've got tons of debt. None of that matters. You just buy it because it's got volume in the trading stock and it's got market cap. So now we've got this huge skew in the markets where you have so much capital that's sitting in these very, very overvalued equity markets. And you go, well, what are the reasons for this capital to go in? Underlying everything, it's the economy. It's good. It's the old saying, the economy is stupid. So where you have, and we're seeing this, there's a weakness in broad economies. If you, no matter almost where you live in the world, if you're certainly in a Western jurisdiction, you will drive down to your average city center and you will see that it's likely worse today than it was 5 years ago or 10 years ago. And profitability of the companies is not as high as it was before, in large part as a consequence of inflation, or I'd say stagflation, rising costs of inputs. And so your wage growth is not keeping up with your actual inflation, and you're seeing more layoffs and things of that nature. Ultimately, that's where, when you've got someone that's got a 401k that's putting capital in, if they lose their job, those fund flows stop. And so that is, I think, one of the major problems that I'm looking at, where I don't know, and I don't pretend to know when this particular thing stops. Mm-hmm. But I do know that you've got a massive divergence between what's happening in the actual economy and what we're seeing in the stock market. The other concern, of course, is related to this, which is that if you take the broad S&P, for example, there are literally only about 15 stocks that are going up, and everything else is flat or going down. Mm-hmm. And so people will look at the S&P and they go, it's going up. Yeah, it's going up, but it's going up. It's what you have is basically rising price and falling volume. That's almost always a precursor to trouble. Mm-hmm. So, that's my rant on the kind of equity markets in general. But again, take the 40,000-foot view. We've got this distribution where most of the world is valuing assets in the financialized world, right? I would say it's a problematic valuation when your actual productivity, the economy, the actual the work being done is not even in the West any longer, and it's largely the valuations on it are much lower. So the areas that we're investing into, for example, broadly commodity markets across a range of different things, we just have these incredibly low valuations relative to basically financialized assets. And it's also very geographic. It's a very tough time to be investing because you've got to deal with sectors as well as a very real geopolitical reality, which is global conflict and a bifurcation in the world largely between the West and, we call it the BRICS. It's just loosely true.
Mm-hmm. Chris, before we get to these long cycle assets, as you call them, the commodities, I think one piece of risk that we didn't really touch on there is this idea that, maybe even a 10% rebalance of these Western markets can really have an outsized impact because of the derivative market on top of this as well. So can you explain to us a little bit more about how that ends up being such a dramatic shift?
Yeah, shit. I mean, so much we could talk about with that. Look, we've got when we're talking about the derivative market, you've got the big, and we haven't even touched on this, the big daddy here is debt. Okay, so in particular. Again, we've got a situation where you have the largest markets in the world by stock market valuation and market cap no longer produce anything broadly. It's all been financed by debt. They're also socialized countries, and so they've got massive obligations to their citizens. And there's an absolute inability for them to pay back those debts. On the back of that, you have a whole lot of multiple derivative contracts up the wazoo, which are, in a domino effect, fail as soon as one thing fails. And this is why I talk about this distribution in the short term, because that distribution can switch, and you've got entire derivative chains that are built on the back of it. And really the biggest one is actually ultimately sitting with sovereign debt markets. So we have in front of us I think potentially sort of once in 100-year type cycle, which is, I don't know when it turns. I could argue that the sovereign debt markets turned back in sort of 2016. We had a bump in 2020, which allowed for them to kind of for bonds to get bid in that fiasco that we had there. And my hat off to the central bankers that managed to take a situation which looked like it was about to fail. I don't know if anyone remembers the repo crisis, and gilts going no bid. Gilts, by the way, are your British Treasury markets, which is massive, accounts for about 2/3 of all UK pensions, and that market went entirely no bid. And then, of course, we had the cerveza sickness come along, surprise, surprise, and a flood, and so you shut down businesses, which is your equity markets. Okay, so what do? Well, you go into bonds, and so they literally saved the day with flooding capital back into the bond market. But again, so if you look at these long-term charts, that hasn't stopped that end of the debt cycle. So you kind of got the end of the debt cycle, inflation coming through, and then at the same time, you've got this anomaly within the passive capital flows, which now today is far and exceeds the distribution that we had in the TMT bubble. We're at now, I think it's about 32%. The largest 10 stocks in the S&P account for about 30, I think it's 32% of the index. That's never been that high. Back in the TMT we had, it was not half that, but just over half that. So again, it doesn't mean that it can't get more crazy, but from a probability perspective, you don't want to be making that bet. The flip side of all of this is that your uncorrelated markets largely, and you talk about say a 10% rotation of capital, going into sectors that are unloved, unwanted, I think that's already begun taking place. We've been talking about this for years, and so there's a couple of issues here. So we talk about our flagship portfolio is called the asymmetric portfolio. So what is asymmetry? Asymmetry is two things, and people always think about, it's massive upside. It's not. Forget about the upside. Asymmetry is also having relative low downside. Okay, so if you take your component just within the energy space, energy as a component of the S&P 500 is the lowest it's been almost in history. Okay, so if you have these large pools of capital and they get redemptions and they got to sell, what do they sell? Well, they sell what they own. Do they do they own much of the energy index within the S&P 500? No. In many instances, some of the companies we own, they can't even own them because they're too small. Again, if you're running a $5 billion fund, you can't go and buy small cap energy or small cap almost anything. So that protects your downside to some degree, right? Where your large capital flows that are pulling out of a market are not pulling out of the markets that you're in because they weren't never there. The second is what'll happen is, because most of the time it's algos running these things. They go, okay, something can get triggered, right? So you could have, Mag 7 down 10%. If it goes down 10%, sell half a point. As an example, I don't know what the algos are sitting at, but that's the kind of methodology that these things are built on, right? When X happens, Y happens, and so on and so forth. So you can easily have a cascade because now it's down 10%. Then if you have a bunch of algos that start saying sell half a point, it can go down 11, 12. And when it's down 15, 20, then the selling kicks in. And this is automated selling. This is without Joey Sixpack looking at his retirement plan evaporating, going, oh no, get me out. And actually calling for redemptions. That often comes later. The retail always late to the party. So in that environment, the other component behind it is they'll seek for what are the sectors that have been doing well that are contra to the one that you're in, right? Again, this stuff's built into algos. I've spoken to guys who built these systems, and I got a buddy who in his past life did this for a lot of the banks. So they'll go, what's been doing well in the past 6 months, 12 months, did it? And they have an entire distribution as to how they might go about now allocating, okay? So when you look at that, like a lot of the stuff that has been unloved doesn't go down. And B, if it's actually printing money, as a lot of these are, it's slowly getting a bid. So we're owning in our portfolio the stuff that nobody wants to own and still is not owned by active fund managers, of which there are very few left, and certainly not by passive. And yet it's been going up. It's been going up to the extent that we've beaten the S&P 500 and quite handsomely. And that's despite all of this like negative connotations behind it. So I don't know. I'm not going to sit here and go, well, I think it gets a massive bid, but it could just get it could either get no bid, in which case, well, fine. It just sits in, it does what it does, but it doesn't get sold because they don't own it, or it starts getting a passive bid. But certainly that passive capital is very, very problematic. It's problematic because I think the passive capital flows into those passive buckets are going to start lessening just because the economy is very poor. We've run out of all the COVID money that's been dealt, it's been done. And now we've got inflation coming in and biting at the heels of actual corporate profitability. And corporate profitability then translates also into layoffs. And that's your average person that's now no longer contributing to those passive capital flows, or contributing less, or people working longer hours and getting paid less, or working less hours because they get a time cut back and so on and so forth. All of these things we're seeing in the actual economy. So that's the situation that we're in, like a microcosm.
So in a lot of ways, Chris, it sounds like you're trying to be ready. Of course, I say this all the time, nobody has a crystal ball for when this rotation ends up happening, but you're investing to be ready for when it does happen and to be out of the way of that.
I think it's, look, part of it has already, Tom, sorry to cut in, Tom,
No
part of it's already been happening.
Yeah.
If you go and you look at the sectors that we're largely invested into, they've been in a bull market. It's just a silent, quiet bull market that no one's really paying attention to. At the same time, part of it's also masked by the fact that everybody's still focusing on NVIDIA and all this other garbage. Okay, because it's getting these passive capital flows, and it's just automatic, robotic, lobotomized, brain dead capital moving into it because it's been going up. It's literally buy it because it's got liquidity and it's continued to go up. And algo says if it keeps going up, you just keep buying it. So it just does. But at some point, that gravy train stops. At some point, those underlying flows of capital into the passive buckets starts slowing, and it's already begun slowing. So, I mean, just in the last week, I don't know if this is it, but Mag 7 is down like about 7%. And then it's funny because at the same time, your micro caps are up about 12%. You can pull up the ticker IWC, which is a good reference for that. That was up like 12%. Your mid caps were up 5%. The Dow, for example, has up about 4%. Now, again, this is a short time frame. It might be meaningless, but that's your distribution that matters, because when that capital stops flowing into these really ridiculously overvalued equity markets, and it's not just that it stops going in, you have frightened capital. It starts moving out, and then it's now looking for a home, going, where do I hide? So I think in the short term, you can make an argument to own bonds. We work on a 3 to 5 year rolling time frame, and across that time frame, I have no interest in owning bonds whatsoever. We're in an inflationary environment, or I'd say stagflationary, which is unusual for most people to think about. That's why I think everyone's getting inflation wrong. They're like, oh, we can't have inflation because look, there's no growth. You don't need to have inflation as a consequence of growth. It can be as a consequence of supply destruction and monetary inflation. And those are things we're seeing. The other thing that I always say to people who have an argument with me around deflation is, on an international basis, we're at war. I mean, we are. It's maybe not visible, and just because the MSM isn't talking about it, doesn't really matter. The point is we're in a conflict environment. Show me one period of history where any conflict environment has been deflationary. Show me one. They're inflationary. So now that doesn't mean that within an inflationary period we can't have 12 months where bonds get bid. Of course you can. But again, we're working on a 3 to 5 year rolling time frame. And across that time frame, I don't have any inclination to own treasuries or bonds or anything else like that.
Chris, you mentioned the repo crisis, and I think, a big piece of this that I don't think gets acknowledged enough is the amount of liquidity that is required to keep these markets afloat. How do you try to analyze liquidity, and is that one of the biggest components of being able to, kind of as you said, be able to keep the system perpetually moving? As you said, that you had tipped your hat to the central bankers to be able to kick this can down the road even further.
It's a tough one to analyze because there's so many moving parts to it. Lynn Alden does a lot of fantastic work on this and looking at the Fed balance sheet and looking at liquidity and so on and so forth. And so I would point people in her direction. She's amazing on that front. The way that I've looked at it is, in the short term, I've kind of stopped looking at the indicators. And the reason that I've stopped doing so comes back to my time frame, 3 to 5 years. Look, we're not going to change the trajectory of outcome here. It's impossible. It's literally impossible at this point. And so, like, I had a period of time a few years back where I was spending a lot of time on that, and I was like, I almost got myself into I was focusing so much time on the weeds, and then I stopped, and I looked back on what was at least a sort of 18-month time frame, and I was like, you know what, Chris, you're an idiot. None of all of this energy and work you've been putting into the noise, the weeds, matters. You know what the overall trajectories are. So long as you can consistently keep double checking and seeing where things are going, and you don't see any major divergence, then you play for the long outcome. That's it. Don't get caught in the weeds. So basically, and we can look at those. It's debt levels. Your liquidity is gonna change it changes too much and too quickly. And I think, at least for me, there's a risk to me looking at these changes and then trying to make an allocation decision based on what are short-term indicators, which don't make any difference to the long term. It's like if you and I are living in the mountains and we're going to drive down to the coast to go for a surf, it's like every now and then we go up a hill. Sure. But like if we're going from altitude to sea level, we're going down. Right. And so that's like it, so now should we worry about like our journey? I'm like, no, I got to stop worrying about that. I'm going from altitude to sea level, focus on that. So that's kind of how I view it. And again, I say that because I literally did spend quite a bit of time doing things I think which were in hindsight relatively unnecessary.
Well, of course, I think it only takes time and perspective to be able to learn those lessons and really be able to apply them properly on what ends up actually mattering for that longer term. But, as we're talking about this, you mentioned your time frame of investing, let's say 3 to 5 years, I think you mentioned earlier. Acknowledging that, most of our listeners understand the Great Reset and the risks associated with, let's say, holding shares in companies in brokerage accounts. How do you think about that particular risk and invest accordingly when you're considering a longer term time frame like this?
A very, very good question. It's one that's troubled me a lot. We spoke about it recently in Istanbul at an event that we were doing there. My answer David Webb, as many of your listeners probably know, is a friend, and he's done fantastic work on looking at those risks. And he's currently doing fantastic work on trying to alert and get some legislative changes taking place in certain jurisdictions in the US. There's two things I think to consider. One is if a great taking, as he references it, if a great taking does transpire in the way that is possible, and it's certainly possible now, we would have international global war immediately. That's without a doubt. Mm-hmm. And then we're in a situation where we've kind of got bigger problems to deal with. So that's one thing. I think there's a lower. I think the probability of it being done at that level of scale is actually lower as a consequence, right? It's not about people like you and I that matter and our brokerage accounts getting posed. Mm-hmm. If you look at the way most governments and power structures around the world exist, the people that are standing on the podium in most instances, almost all instances, are not the real power. There is money and influence behind them. That money and influence is largely invested in many instances in a similar fashion as to how you and I are. They matter. Okay. You start taking out Chinese, Russian, even Iranian influential people behind that have the ability to move governments, you go into a very different situation very quickly. So I think I'm not saying it doesn't happen. That's just something to consider. And then the other obvious answer to this is to have asset classes that are in your portfolio that are outside of any financial system, right? Physical precious metals, I think physical real estate, counter-jurisdictional and counter-trend. So in large part, that's I know you're part of the Mavericks group that we've got, and that's largely what we're looking at addressing. is basically the great reset and saying, okay, like, what are we going to do there? Well, we're going to invest into counter-cyclical, counter-jurisdictional asset classes, in particular things under the sort of Maslow's hierarchy of needs, food, shelter, agriculture. And so I think, at least for me, that's my mitigation strategy for that outcome or potential outcome. Because I don't know, like, I don't know how to quantify that risk. It's very difficult for me to, like most things, I can quantify risk behind NVIDIA. I can quantify risk behind bond markets. I can, all these things. Why? Because you've got a trajectory of history. You can go back and you can have a look and see, okay, what do the numbers look like? What has happened in the past, et cetera, et cetera. We don't have that ability to do that with respect to the great taking. This would be like, use the word unprecedented. I mean, yeah. So I find it difficult for me to quantify that risk. What I do know is that I do want to have some assets that are outside of the system entirely. And look, there's something I'll just throw out here, which is kind of related. Like, we just had Cloudstrike thing take down, which, if you, from my understanding, reading people who know things about both technology and security, digital security, and so on and so forth, this is the explanation given is complete bollocks. It doesn't make any sense. We're not, and then we did this the other night. A bunch of my buddies and I, we were looking, going, okay, what happened where, and who was affected? And there's entire swathes of the world, Russia in particular, that had nothing go down. And then, so like, you go back and you go like, why is it that Russia is now one of the fastest growing countries in the world? Well, because back in sort of 2012, they started de-dollarizing their economy. They started, they went through a very deliberate change to how they were running and operating the country, both in terms of how they were, like, industries that were being promoted, trade routes, the whole lot. And so this is why sanctions hasn't made, it's the most sanctioned country in the world, and it's now the fastest growing economy in all of Europe. Cloudstrike, another example. So, well, they took them out of the SWIFT system, hasn't made any difference. Technology breakdown, nothing. Like, all Russian airlines were still open, all the supermarkets, everything functioned perfectly fine. So what I'm saying is that there's a bifurcation taking place in the world. Okay, so if you're sitting in the Western markets and you're sitting there thinking, oh, Russia bad, I'm just using them as an example. What you've got to understand and realize is that they are at war, as you are in your government is. Having assets in the other side makes all the sense in the world to me. All the sense in the world. And so whatever fuckery they throw at us, whether it be takedown of internet infrastructure, censorship, whatever, I want to have footprints, and I like to think of it as railway tracks. I want to have railway tracks in multiple jurisdictions so that if I need to, I can go and put rail cars on them. And in some instances, I'm already putting rail cars on them. And I think that's very important, because I don't think that whatever transpires is going to be homogenous. It's like, right? The extent of what COVID taught us, it wasn't totally homogenous, and I think the next iteration is going to be even less so. And the time to prepare for that is before it happens. It's now.
Absolutely, and it's really, I think, important to be thinking about, as you say, these global shifts. You mentioned war as, such an important part in some ways of the industry of a lot of these countries, of a lot of Western countries, especially at this point. When you're looking at investing in alternative jurisdictions, do you look at, or do you consider the military industrial complex of some of these countries that you see a capital rotation coming into or out of? And do certain countries pique your interest because of the way that they handled their warfare, let's say?
Yeah, it goes across warfare, goes across every industry. Each country has largely its own deep state, basically. You've got some countries where it's almost not required, right? Your quote unquote authoritarian countries don't have to hide behind anything. Okay. There's also relative stability that comes with that. And I've been making the case for even pre 2020 scam that as we see a collapse in Western debt markets in particular, we'll see a couple of things. One, we'll see capital flows and human capital towards jurisdictions which represent safety and stability. The story that we've become familiar with, at least in the West, for all of my life, is no, you don't want to go to some authoritarian country because they don't have democracy. If there's anything that the last 4 years should have taught people, is that democracy doesn't exist anyway. It exists in name, and it exists with respect to maybe CNN in their minds, but in reality, it doesn't exist. Did you have any say in when they locked you down? Did you have any say in when they forced you to, or tried to force you to take some experimental juice? Democracy is increasingly seen for what it is, which is not accurate, at least, to say the least.
I feel like that word has become a placeholder for an idea rather than, a definition that is unchanging anymore.
It's become, like many other words, completely corrupted. By design, I guess. Nevertheless, you have in that environment, again, things are always relative, right? So you can have your average NPR, like it will be like, okay, I don't want to go and live in an autocratic country run by, take Dubai. I don't want to go live there. It's run by people that don't have any democracy. You got no freedom of speech. Okay. And then they look outside their door and there's rioting taking place. And the business that they own just got torched. And the government's now introducing, like in France, where they're talking about potentially a 90% tax on the wealthy. How they define the wealthy, I'm not quite sure, but nevertheless, 90%. So if you fall into any of these brackets, you're a complete moron if you sit there and go, okay, well, I guess. Right? And so most won't do it. And certainly the wealthy are typically intelligent enough to not sit there and go, I'll take it. So they'll leave and they'll look around, and on a relative basis, they'll say, you know what, I'll take safety and security over the ability for me to have any say in a political system. So they'll choose to go and live in a place like Dubai because their daughter can walk the streets at 2 a.m. in the morning in a miniskirt and no one's going to touch her. And their daughter can't do that. Your daughter can't even walk down the street in the middle of the day in Chicago without potentially getting into trouble. So the relative decisions become quite easy to make. That's a human capitalist shift that I think is going to accelerate. So you're going to have the other component behind this, and it's important from an asset allocation perspective, is this. Where you have a presidential or election cycle every 4 years, and things are kind of benign, then it doesn't really matter so much, and this is largely the case that you had both in Canada and the United States, many places. You've got your red and your blue, you've got your conservatives and your Labour, and you've got your whatever, okay? Broadly, that's how it's looked across much of the Western world. And it hasn't been that much change, right? Every 4 years, maybe it changes, maybe it doesn't. There's a few things here and there that change, but basically it hasn't been that disruptive. You're a capital allocator and you want to go and build some infrastructure. And let's say your payback time, this is into like long cycle assets, which we alluded to earlier. If you got let's say you got a drill rig, like payback's 25, 30 years. Okay. So in that environment, you're like, okay, yeah, I can go and deploy the capital because we might have a red team or the blue team or whatever, but we're not going to have a purple team. And we kind of know what the red and the blue look like. And, we can work with them. That's gone away. Now, like anything's on the cards, okay? In that environment, you look around, you go like, even if I picked a place where the political cycle looks like it's changed, and I now have a leadership in there that might be doing things that are favorable from a business standpoint, what happens in 3 years' time or in 4 years' time? And it might take me 4 years just to actually deploy the capital, to raise it, to go and deploy it, and to start building a drill rig or whatever. Doesn't really matter what the infrastructure is. I'm using that as an example. Contrast that to an environment where you go, hey, the Sheikh's been in power all his life, and when he's finished, his son's going to be in power. And what does that economic structure look like? It hasn't changed that much. Now you've got an ability to deploy capital over time with the consistency of political structure, right? That allows you, to raise them. And look, despite what you might have your own views on the politics, but if you're going to go and raise money, and most of these things, long cycle infrastructure is always debt-based, you've got to raise the money. So that's looking for other shareholders. They want security of outcome. They'll look at that. So again, and we're going to see, and we're already seeing this, a shift of capital into jurisdictions that A, promote it, make it like feasible, and B, have a relative certainty of outcome over a time, a significant enough time frame. And so this is a huge issue for quote unquote democratic political markets, because they're so topsy-turvy at the moment. It's very difficult for capital to be allocated. And if you go through like at least a decade or two like that, that can really alter the shift of global trade in a hurry, where you've got a divergence and you're seeing capital being allocated to one region and not another. Again, you're putting in major long-term assets. The UAE, for example, is just putting in another nuclear power station. Like that takes 10 years to get put in place and to get going. Why are we not seeing that sort of stuff taking place in Europe, in the UK, in America? There's a whole host of different reasons, but the longer that remains the case, that's your bedrock to an economy, right? Why is it that the Chinese can do a nuclear reactor? What was the numbers on it? I was talking about this recently. It was like, in the US, it was like for every megawatt of power, I'm going to get this wrong now. Anyway, it was about 10 times. I could look it up and send it to you later, but the Chinese can build and deliver energy for a tenth of the cost in terms of nuclear power. Mm-hmm. Like that has a massive impact on the entire economy across the whole space. So sadly, this is just the case of the situation that we're in. And some people ideologically moronic, I guess, might look at what I'm saying and saying, oh, you're a proponent of China and of Russia and all. I'm just laying the facts bare. That's what it is. I don't like it, but that's just the reality. That's where the capital is getting deployed. That's where the infrastructure is much better, and that's where the economic growth is. Is what it is. So,
and as we know, energy is directly tied to GDP. As energy grows, GDP grows. And I think that's a very, very important point to remember. But Chris, as somebody that has lived and invested in 7 different countries, as I introduced you, considering this framework of how you see these shifts happening in the world, what are some examples of countries that appeal to you to be living and doing business in?
The different questions. Where I live, I don't necessarily need to do business. Okay, so it's an important distinction. I'll quite happily deploy capital into certain countries which I might not have an interest in living in. Mm-hmm. And I think that's it's the 5 flags theory. I'm sure your readers are familiar with it. If they're not, they can go and look it up. So where would I want to spend time? Well, I think in this geopolitically fractured world, Europe is incredibly problematic. It's probably the most blood-soaked earth on the planet. I can see that transpiring again. Mackinder's heartland is always going to be fought over, and I think that's going to continue to be the case. In that world, I would say that Latin and South America are most favorable to me. Again, not necessarily for investment. It depends. But in terms of physical locality, they make a lot of sense to me. There are some that I think make a lot of sense for investment too. Anyone that's been following us would know that we were very early into Argentina back in October of 21. And we're looking at quite a few private assets there as well that we're going to be putting capital into. So that's one that I would put in the bucket of both, where I'd potentially like to also spend time as well as deploy capital. It's mostly Latin and South America. There are other parts of the world where I'll deploy capital, but I don't necessarily want to live. That's outside of the sort of financial, stock brokerage stuff that we run. In that space, we still do the same thing. We'll still invest into assets. Just for example, we just recently put out an alert that for a particular company in Ukraine that we're buying. I think we're only months away from a peace deal being signed or some ceasefire of some description. The deep state's probably got what they need out of it for now. BlackRock's going to walk away with most of what's left of Ukraine. So you'll own nothing and be happy, basically, for the Ukrainians. And BlackRock will be very happy and they'll walk away with what they wanted. They probably wanted more, but they'll take it as a win. But capital, but yeah. So obviously the assets are super cheap. So I think we're going to get a bid on that. And obviously, when you're going and you're buying into a war zone, it doesn't take much to move the needle when hostilities cease. And so I think we're only months away from something of that nature. Yeah, it's to some degree, Tom, I don't like answering the question just because everyone's situation is different. And then you get people going, oh, well, you said this and you said that. I'm like, you need to make up your own mind, but go and do your research, Or if you're looking for that plan B thing, then get on a plane and go and check it out and go and spend some time and do your research. And what's good for one person might be not so good for others. So my bets in terms of capital and plan Bs have been Costa Rica, Argentina. I think that we've already seen a lot of benefit, certainly in a place like Costa Rica. It's boomed. The moment we have some false flag event in the US, I think it's just going to go up even more. It's a tiny place, 5 million people. There's no, it's like you're buying a small cap. You're basically buying a small cap. It's not cheap anymore, but it won't matter. You have your average urbanite in the US who turns to her husband and goes, honey, there's shit outside the door. Get me out of here. And anyone with any sort of relative wealth is going to not be too concerned about whether they pay $800,000 for a house or a couple of million to get out of Dodge. So, yeah.
That's a fair answer, Chris. And I do appreciate your honesty in regards to answering that question. But is there anything that you didn't cover in that answer that you think is necessary for people that are considering making a move like that or getting exposure to alternative jurisdictions where capital and or citizenship is treated better than it is in the West?
What to think about? Look, I think the first And the easiest thing that people can do is to set up banking, for example. I mean, I grew up in Africa, and then I had friends who were in Zimbabwe, and I mean, I had a good friend and whose father lost absolutely everything, a very wealthy man who ended up with nothing. And I often looked at him like, God, if he could have just literally got on a plane, had more money than God on a Sunday originally, and he could have just gone and opened a bank account and just put a little bit in, like, something. And he just didn't. Even as things got worse and worse. There's a certain, like, if you have any significant wealth, I guess there's a certain belief that you'll always have it, or you will always have enough, and that's not always true. So diversification, I think, is really important, and so people have often, like, I get asked this question a lot. It's like, oh, yeah, where do I go? Which one? I'm like, pick a bunch. Like, does it matter if you went and you open 5 bank accounts and have one maybe in, I don't know, Eastern Europe, and then have one in Latin America, and, like, who cares? Like, if you've got them open, when you see things coming down the pike, you might at least have the ability to move capital into them. Like, if you don't have them open, it's going to take you weeks to get there. You don't have the time. And if you've got enough capital, go and chuck some in there. So you go through iterations, and then the next iteration is, okay, let me deem the various jurisdictions that I think are panning out to be the way that I thought, and keep in mind that you're going to fuck things up. There will be places you think that worked out, that was good, and it transpired that it's not. But now you start building cash flows in those places, so you buy into some particular assets, and they could be even listed, notwithstanding the risk that you might have from a great taking, but it's another avenue. And then the other can be non-listed. So I'm a big proponent of getting involved into cash flowing businesses in jurisdictions like that. As you probably know, it's one of the things that we're looking to do with Mavericks. But it's dependent on people's own financial resources. It's dependent on their own knowledge. The first thing you do is start educating yourself fast. And there's probably no better way to do that than nowadays online. I mean, everything's like free online. There's really no excuse to being ignorant any longer. And then the next step is booking a trip and going and checking it out. And there's there's so many resources of people that can help you, that can really facilitate in going about doing that. Mm-hmm. I'm still puzzled as to how many people will just sort of blithely go, don't really need that, not worried about that. Again, probably as a consequence of my background and my upbringing, having watched these things going on, and then seeing how catastrophic it can be. I just have a different mindset to I guess most people. But
Chris, in that vein, how do you think about or handle fear, uncertainty, and volatility in your life?
Fear, I think fear is a useful tool in the short term. It's kind of like, you're on your off-road bike and you're gunning it, and then, like, you're coming up on a corner and you're like, oh shit, I've overcooked this. I need to. So, like, that fear is useful, right? Because it can save your life. But fear for the sake of fear and not taking action when you have the fear is actually just completely debilitating. Okay, so it's like you not tapering back on the throttle, right? Now you're just going to go over the edge, and then you really have a problem. Like, you might come off, but if you've tapered back a bit, you might come off not as badly, right? Mm. And so wherever there's, like, fear is your brain telling you that you need to pay attention. It's it's a primary instinct. So I think when you have that fear, you need to pay attention to what it is, but then immediately go about solving the problem. Don't wallow in the fear. Get rid of the fear. The moment you start taking action is the moment your brain starts working towards a solution, and then you don't have fear anymore.
Mhm.
So I see too many people kind of just wallowing in the whole, there's no hope, and we're just, and then just they literally sit in a wallow of pity and shittery, and I think it's completely useless.
Mhm.
And they like go on and on about how everything's wrong. I'm like, fine, it might be wrong, but what are you doing about it? Oh, well, there's nothing to do. Well, then shut up. Just shut up and get out of the way of the people that are doing shit to make it happen.
Mhm.
Either be part of the part of the solution, or get out of the way. So I think, and when you take that kind of mental stance, you don't feel fear. You feel energized, and you feel good about yourself. For me, that's how I deal with it, because like, what's the alternative? I don't think the alternative is good for you anyway. You'll probably end up getting fucking cancer or something just because so. And look, it's still better, I would say, to live life through that lens where you're actively, purposefully moving forward and still fuck it up and get it wrong. Because what's the alternative? You could do nothing and get it wrong and then have some bad outcome. I'd rather live those years up until the bad outcome in a positive fashion and still have the bad outcome. It's still a better choice. And I'm increasing my probability of outcome massively, because you start training your mind. You callous your mind to solving problems. I mean, this comes into a whole different conversation around basically our education system, and I think that people are in general, we've not trained our youth how to think, and they're always just like, when people go, oh, I'm looking for a solution, they don't stop, and they want a package. Literally, they're like, oh, give it to me in a packet. It's like a microwave deal. Like, it doesn't work like that. You go and solve the problem yourself. So, but the way that you're an entrepreneur, you know what it's like. Like, how many times have you had things go wrong in your business and you've had to go and solve them? Like, all the time. So you get used to it, and then you get to a point where, like, those problems that you encounter aren't that big a problem, because like, I've dealt with this before. I know how to deal with that. Okay, I've done this before. Do that. And so whereas someone who's not used to it, like, I mean, every now and then I have this experience where I talk to like an employee mentality, and I'm like shocked out of my world, because I'm like, shit, these people have got like no skills. They don't know how to solve a problem. Like, they just stop. Brain just stops. They're like, oh, I can't do it. I'm like, what do you mean you can't do it? Like, you have to. You have to figure it out. Oh, well, I can't. So you start thinking and challenging yourself and just solving problems. And that's a good way to live life. You feel positive about it.
Mm-hmm. Yeah, I think, a really important point, just to underline what you're saying there, is take that fear as practice. Start putting yourself in those situations. Acknowledge the fact that you are going to make some mistakes, and as you build that skill of challenging yourself, you're only going to end up in a far better place by taking those risks and understanding that, when you do encounter problems, it's not going to be the end of the world. You can very often solve a lot of those issues just by, having a little bit of ingenuity.
100%. You can't get worse. Like, how is it possible that you get a challenge and then you go through the experience of solving that problem? Like, how are you possibly coming out a worse person?
Mm-hmm.
You can't. Like, you literally can't fail. Even like the constant failures that you have along the way are just lessons. And so, I mean, it kind of almost sounds like bloody guru woo-woo stuff, but like, it's just, it's so true. Yeah.
Absolutely. Well, Chris, I really want to thank you for your time and, explaining a lot of different concepts to us today. For anybody that wants to learn more about Chris and what they're up to, that's all available at CapitalistExploits.com, and of course on Twitter as well at CapitalistEXP.
Yeah. Actually, the web URL is .at. I think .com redirects there as well, but yeah.
Okay, excellent. Chris, thanks so much for your time today. Really appreciate it.
It's a pleasure. It was good to finally catch up with you. Thanks a lot, Tom.
Absolutely. This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.